Dennis Tubbergen here with another video market analysis. Today we're going to take a look at the US dollar. On the screen, you'll see a weekly price chart of the US dollar index. Symbol is DXY if you want to check it out yourself. I'm using TradeStation here, but you can go to Yahoo Finance or Bloomberg as well. I've taken DXY all the way back 20 years. I've taken it back to 1998. Now, if you take a look at this chart, and incidentally, the US dollar index measures the purchasing power of the US dollar against the 6 major trading partners' currencies of the US. So in other words, we're measuring the purchasing power of the dollar against the purchasing power of the currencies used by the 6 major trading partners of the United States. Now, if you go back here, you look at 2001, 2002, and to put this in context, that was about the time of the tech stock bubble breakdown. You see that the US dollar got weaker as the real estate bubble formed. Now, that's obviously not a coincidence. At that time frame, the Federal Reserve dropped interest rates from 6.5% to 3.5%, and in a fractionalized reserve banking system, that means that more money is created. The more money that's created, the weaker it gets. So as you saw, the declining dollar there, preceded by a double top, which is a pretty predictable technical indicator. You see the dollar got weaker and weaker and weaker and continued to get weaker all the way through the financial crisis. Since the financial crisis was somewhat worldwide, the dollar gained in purchasing power, and you see starting here in about mid-2014, the US dollar index rose from about, we'll call it about 80 to just over 100. Now, if you look at this recent pattern here, you see I've got the trend lines drawn here, and it forms a megaphone pattern. Now, a megaphone pattern is really a big red flag in technical analysis. The trouble with a megaphone pattern is it can be a continuation pattern or a reversal pattern. Of late here, you see that the US dollar index has broken down below the bottom boundary of the megaphone, which seems to indicate this may be a reversal pattern, that the US dollar may be getting weaker. And if you take a look at this line that I've drawn across here, it was really a point of resistance back in 2008 and 2010. It is now serving as a point of support. So we're at a key crossroads here. If the dollar breaks down from here, we could see, I think, the dollar break down quite a long ways. And I would think that that may be our expected outcome here. If you take a look at this chart, this is a chart of an exchange-traded fund that tracks U.S. Treasuries. This is long-term U.S. Treasuries, the ETF, and this is obviously not a recommendation to buy or sell, but the ETF is TLT, which is the Barclays long-term U.S. government bond fund. And if you see here, bonds have been up, down, up, and now down. And I've drawn this blue line on the chart here. This is really forming what I would say is a perfect head and shoulders top. Now, a head and shoulders top is typically a reversal pattern and means that the U.S. Treasuries will likely decline from here. A head and shoulders bottom is just the opposite. It often means the market is ready to reverse. Now, using technical analysis, we would expect that we could see U.S. Treasuries drop here to in the range of about 90. We see the peak here is at 143. If I draw my cursor here, the current level is at about 117. We've got a difference of 27. So 117 minus 27, if it drops as far as the head and shoulders part, that puts us at a target of about 90. And what that means is yields will go up significantly. So I think what this means is that it could potentially be setting up to be a bear market for U.S. Treasuries. It could potentially mean that the U.S. dollar is going to get weaker. And when you look at what's going on around the world, fundamentally speaking, relating to the U.S. dollar, that all makes sense. Today's economic update on video talks more about the fundamental reasons behind these technical setups. That's today's video market analysis.